Hey, everybody. Good afternoon. Good afternoon. Good afternoon. Happy Monday. Where are we? Monday, August 11th. August is flying by. I am an associate member of T3 Trading Group, which is an SEC registered broker, dealer, and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you. Excuse me. In light of your own financial condition. And there is the position disclosure. It's basically the same as the end of last week, except some options hedges I had expired. All right. Let's talk about the market. It was an interesting day today. Actually, first, Dave S. here. Let you guys take a look at this on your own, but he has been working on a strategy, a signaling system, something like that, that he wanted to share with the team. I think it's for like mean reversion counter trend signaling and provide us with some information in a Google Doc. So I will highly encourage you guys to check that out on your own time. Love the teamwork. Love that Dave is putting the team first on an indicator that he's been working on for his own trading to try to benefit everyone. So thank you for that, Dave S. A great example of what we want to be doing here as a team. And again, it's something everybody should check out on their own time. All right, let's jump in here and talk about the market. All right, so SPYs here finished roughly down 0.25%. The NASDAQ finished down about 0.35%. The IWM finished flat. TLT flat. The dollar is up again. UP ETF back above 27.50. I think that could begin to weigh on equities a little bit. Maybe we get a dollar short squeeze at a certain point. I keep watching that 27.50 is an important inflection area. Gold got hit down when Trump said that he's not going to be putting tariffs on gold. Bitcoin up 2% on the day, but closed kind of weak and very much off highs. Not a great looking daily candle, but still up 2% on the day. And oil is up 0.7%, but that's just like a little bounce back after getting smacked down last week. All right. Let's talk about the day, and let's talk about the charts, and let's talk about inflation. Starting with today. So, this market's really something. We saw headlines hit on Sunday that Trump is going to be charging NVIDIA, AMD, semiconductor companies. It's primarily, I think, going to be NVIDIA and AMD. I think a 15% tax to export semiconductors to China, which is interesting. I don't think I've ever seen a policy like that before, ever. Some people seem to be arguing that it might not even be constitutional, but we know that AMD and NVIDIA agreed to it. So maybe that was part of a deal to be able to sell the chips. I really don't know. It's interesting because we saw, I'm pretty sure at the end of July, Trump and the US government already agreed to allow NVIDIA to sell those H20 chips again and things that I guess are similar or not as good. And we had a pretty big up day, if I remember correctly, in the semiconductors on that news on that day. So to me, the fact that, all right, we're going to allow you to do it, but now 2 weeks later, we're saying, but you have to give up 15% to the government seems like a pretty big negative to me, unless I'm missing something, unless this opens the door for these semiconductors to sell even smarter chips than the H20. But I didn't see any language about that. All I saw was that, all right, you know, those chips that we just said you could sell to China like a week or so ago, now we decided you can, but you have to pay 15% to the government. And if you look at the pre-market charts of NVIDIA and AMD, they got hit real hard. I mean, you can even see the SPYs while I still have it up. Downticked real hard at like 4 a.m. NVIDIA and AMD got kind of rocked on that pre-market. So traded all the way down to 179 in NVIDIA traded all the way down to like almost 166.50 in AMD. So to me, that move makes sense. And for the second time in 2 weeks, I thought maybe this could be a catalyst that could enable us to lose the generals, to lose the leaders in this market, which have been the crowded AI trade that has led this market higher. It's been an incredible trade for good reason, some incredible technology there. But at this point, the move has been very, very big. And very crowded, I think, at this point as well. So, is this the catalyst that can bring the market down? That was the question in the pre-market. And if you look at the NVIDIA daily chart, which I'll look at in a second when I switch off the 5 minutes here, if you look at the NVIDIA daily chart, you had the potential of like an inside and down to get through the 180 level, which is a big level. Maybe you lose the ADMA on the daily. It almost could be like a real topping news event for NVIDIA. And we know that NVIDIA positioning per a Goldman Sachs note like a few weeks ago is at like a 10 out of 10 in terms of everybody owns it, right? And if no one is left to own and you finally get the potential of a negative catalyst, maybe that could bring NVIDIA and AMD down. And since NVIDIA is like one of the few things that's really been continuing to hold this market up, maybe you could lose the market as well. That was a potential thought process. And then we grinded up pre-market and we ripped higher. And I still don't get it, to be totally honest. So, granted, a little bit of semiconductor help came from Micron. Micron like pre-announced an updated positive guidance today, and you can see that came out at 8 a.m. and Micron had a huge move higher on that. So, makes sense a little bit. Like you have a negative here potentially with the semiconductor tax, followed by a positive with Micron that could carry through a little bit to some of these other companies. So I could see those weighing on each other back and forth a little bit. But this degree of the snapback from the pre-market low on AMD and NVIDIA is, dare I say, it's crazy. I know Bill K loves when I call things crazy, but I don't know what else to call this move. Pre-market trading on bad news all the way down. It's nuts. All the way down below 167. And then 45 minutes after the open, it's at almost 179. You have like a $12 up move, $11-12 up move in AMD from a pre-market low to 45 minutes after the open. I mean, that's a wild move in the face of what seems like negative news that they just say, yeah, we don't care that you're going to get billions less in revenue that we thought you might get a few weeks ago. We're just going to rip it higher. And NVIDIA kind of same deal. Pre-market low of 179, potentially losing 180, potentially going after the ADMA on the daily chart, potentially giving an inside and down failure pattern. So next thing you know, going after all-time highs. Did it make new all-time highs today? Did it do it? What? 183.84 is today's high about, right? 183.84. 183.88. We did not make new all-time highs in NVIDIA by 4 cents today. With bad news. We had bad news. We didn't make all-time highs by 4 cents. So, that was the first question that I was asking myself this morning. I was like, all right, is this it? And what's the impact on the SPYs? What's the impact on the Qs? Looking at this NVIDIA daily chart, that high from 2 sessions ago is very important, the 183.88. So we've been saying that there's resistance in NVIDIA between like 183.50 and 184. And then you had this inside day yesterday. Bulls would point to this being a bull wedge with a tightening pattern at the end with an inside day, riding up this ADMA, setting up the next leg of a breakout in what has been a relatively 45-degree angle uptrend. Bears would say, all right, you had a deeper correction here, and the new high is basically an equal high, and you're losing some of the acceleration of the uptrend. And with bad news, if you get an inside and down, this begins to look a little bit more maybe like a double top, or the wedge is breaking down, and you're setting up for a bigger correction. I thought with the news factor added in additionally, plus the fact that I've been thinking this market's getting a little bit tired these last couple of weeks, maybe you could actually begin to lose NVIDIA and AMD lose the leaders, and then lose the market. Well, that couldn't have been more wrong based on the initial move. Now, after that initial opening squeeze, especially if you look at AMD, we did roll back down a lot. So it inclines me to think that what this was just again like a positioning squeeze feeding on itself, where people thought they could press downside, and then next thing you know, it's trading higher and people are chasing into the upside because they're like, oh my god, was this the next dip that I was supposed to buy? But that AMD candle here at the end of the day at that upside tail doesn't look good. It's still also in a broad wedge pattern that's starting to build out, so we'll see how that wedge resolves itself. And Nvidia here gave us another little doji. So bottom line, though, is that that semiconductor headline was not the catalyst to lead to a market failure today. And if any, we traded really strong. The intraday price action was really interesting because once we knew that Nvidia and AMD were not breaking down and were in fact ripping higher, the spies and the Qs were still relatively quiet. It is the day in front of the CPI, so that made sense. But then we started breaking out midday, and I think one of the best calls that I had today was calling out that this bull flag was going to fail. And I was writing into the VTF. I was no longer on the radio at that time. I wrote into the VTF. I was like, guys, I really think that this bull flag is going to fail. And I was looking at some of the internal components weakening out a little bit, like AMD weakening out a little bit. But I wrote in the VTF. I was like, I kind of think that this bull flag is going to fail, but honestly, I have absolutely no basis to think that it is going to fail because the trend is higher in every direction. We're at all-time highs. We just broke out. We're bull flagging in front of it. And honestly, the market's incredibly strong. And if we were going to go down, we should have went down in the beginning of the day because that's when the bad news was from the semiconductors there to negatively impact the market. And we did end up failing on that bull flag. And then from there, we had ourselves kind of a real roll lower. So when you turn things back over to the daily chart, it's interesting. And then one other really important piece of information comes from the market dynamics. And this actually probably also impacts the end of last week also. We were seeing via a model that there was supposed to be a massive vol control bid today. From the 3-month look back of realized volatility, you are losing May 12th. May 12th is the day when the original 90-day pause on China was announced, and the market went up 3.3%. I believe that was a Monday. Yeah, that was a Monday. Market went up 3.3% because we announced that 90-day tariff pause with China, which that ends tomorrow. So that's why the 3-month look back is the way that it is. And we announced today that we are giving China another 90-day pause. So kind of us. But at this point, there was no upside market reaction to that, which I think is very notable. I'll circle back to that in a second. But so we lost the final, I think, like really, really big day in the 3-month look back for the vol control funds today. There's one other that's upcoming that's like a 1.3% day. I'm actually not sure which day that is. Just eyeballing the chart. It's probably May 27th. But outside of that, we are finally through, I think, the very vast majority of any systematic buying that's going to come in. And we got an update from the Goldman Sachs CTAs that show that there is, over the course of the next 1 month, a little bit of buying and a flattening up tape. But at this point, it averages out to like $500 million a day. So the systematic bid, as far as I'm concerned, is pretty much done. It's no longer a tailwind for the market, but it's not necessarily a headwind. But that is important for today's trading session because we were expecting this massive, massive bid to come in, and it seemed like it was there in the beginning of the day. However, when it's like a one-off like this, they front run it. So they were most likely front running that number at the end of last week, contributing to some of the upside grind that we actually saw for most of last week. And now the spies here still never recaptured 640. The Qs did make a new daily chart high. They actually were able to get above the July 31st high, but it's not really being confirmed at this point by the spies. And it is certainly not being confirmed by the IWM. The average stock that's out there has still been really weak, and it's still been Nvidia and Avago, and Palantir that have been holding this market up and continuing us higher. And, it's starting to seem a little bit tired to me. So we are finally losing, I think, pretty much the extent of the tailwind that was the systematic bid, which was a really big bid for a really long time. That does not necessarily make it a headwind, right? And there's other positioning that you need to look at, like the hedge funds, like the long short funds, are actually like kind of neutrally positioned at this point. They've got money that they could potentially relocate to the long side. They also have money that they could potentially sell further at this point. They're pretty neutral. But the systematics are finally kind of all in the pool. And the market has been feeling, to me at least, even though we had an up grind last week, for the last, I would say, 2 weeks plus today, the market's been feeling really tired to me. Um, and it's interesting that it's like we still don't really go down necessarily on bad news. Like that AMD selling down on its earnings report was not a trigger for anything more broadly like I thought it might be. This tax on the semiconductors that are being exported to China was not really the negative catalyst that I thought it could be. But we've seen as the market has grown tired these last couple of weeks, and again today, they're also not going up on positive things in the same way that we were. Uh, Particularly when it comes to like trade deals, like Japan, EU. I think when both of those got done, and you could debate whether or not they even are done, when both of those got done, we gapped up and sold off. I'm pretty sure on both of those days. And then today we got an additional 90-day pause on China, but it was so priced in the market. Everybody knew that it was coming. The market didn't even there was barely an uptick on the 5-minute chart when that news actually dropped that we're giving them the additional 90-day extension. So this market feels tired. But tired doesn't mean that it has to go down, right? We could say choppy. We lost a systematic bid, sort of, but that doesn't mean that there has to be selling that has to come in. But if we were to get a catalyst, the ammo is starting to be there for a sell-off. We got an update on the Goldman Sachs model this morning for the first CTA trigger, and it's now above 6,200. I think it's 62.29 for the first sell trigger, but I need someone to fact check me on that because I read it a couple hours ago. But it's above 6,200. It is above the low now from August 1st. It's above that. So if you could get a catalyst that retests the low from a week ago Friday, which isn't that far away. Like it feels kind of far away. It's 62.23. Thanks, Rich. It feels kind of far away because it's $15 down from where we are. But keep in mind, with 2 days of selling, with a catalyst from the employment number, we were able to get there in 2 days. So with a catalyst, you could very, very quickly and easily be seeing the market retest Friday's low. But now the difference is if you break that low, or you don't even need to break it, if you get to near that low, you are triggering systematic selling that could be the beginning of a negative feedback cycle, or it's technically a positive feedback cycle, but it's a positive feedback cycle of selling, where the selling that comes in at 62.23 gets you through 6,200 support. 6,200 support triggers more technical selling because it's a very widely looked at, widely viewed support level. Getting below that Friday low, getting below 6,200, realized vol potentially increasing as well at the same time as realized vol has like nothing left to buy really. And then beneath that, you have the really important like SPY 600, 6,000 level, and the next CTA sell trigger I'm seeing here from Rich is at 6016. So that would be the next zone for the market to attempt to really try to hold a support if you can break through the first one. So that kind of remains the key levels on the downside is that low from a week ago Friday, but I think it's notable that the CTA sell trigger is sitting above it now. So personally, I think if you can get a catalyst that retests it, you're going to break it. I think if you can retest Friday's low from a week ago, you're going to see 600 in the SPYs. is what I think at this point. That's how the positioning appears to line up to me. And then we can be assessing like is 600 the real dip to buy, or are things getting so bad that, we are continuing a feedback cycle of selling. So that would be the next test. Is that the dip to buy or not? But you still need a trigger. And we have a really important event tomorrow. We have the CPI tomorrow. And I don't know what that number is going to look like. The CPI is taking on a lot more importance tomorrow after the non-farm payrolls number that we had a week ago Friday. The non-farm payrolls number that we had was a bad number. But we're in an environment, I've been describing it as follows, where bad news, bad economic news on like the employment and growth front is good, as long as it's not really bad. And the selling that we saw Friday a week ago was kind of in that category of like really bad. Like the non-farm payrolls number for July itself was the perfect amount of bad because it set up rate cuts, but it was the revisions on top of that made it like a little bit too bad. Where it's like, oh my gosh, just growth declining by more than the Fed can even really cut to save the day. But then a lot of the rally back, the grind higher from last week, was attributed to the increased expectation of Fed cuts. I think we saw this morning that as of right now, and this will probably change after CPI tomorrow, the market is pricing in a 90% probability of a September cut, almost fully pricing that in. So the CPI tomorrow is really, really important because if the CPI number, let's say, were to come in hot, comes in worse than expected, inflation is worse than expected, then you have kind of that stagflation scare that we talked about early last week when we had that bad ISM number that is much more difficult, right? If you get a hot CPI, you probably lower the probability of the Fed cuts even as growth is beginning to decline. So it's like the one thing that can offset like the bad is good as long as it's not too bad kind of scenario would be if you got a hot CPI at the same time. The flip side, so a hot CPI coming in higher than expectations could really be that trigger that triggers everything that I was just talking about. The retest of Friday's low a week ago, which is triggering the CTA sell trigger, which is then triggering technical traders and a feedback cycle of selling that comes into the market. An inline or a weak CPI becomes either a non-event or becomes bullish. So I actually think that the risk is to the downside tomorrow. I think that there's more risk on the market going down more on a bad CPI than there is the market going up on a good CPI. The reason I think that is because you're already pricing in a 90% probability of a September cut. So CPI coming in light or coming in line just basically says like, all right, we're already pricing in the 90% chance of a cut. We're good to go. And maybe you see that increase even further. But I think if you get a really hot number, it could be bad. So that's to be seen. Ryan here giving me the JP Morgan expectations. Let's have a look at that. 5% chance a core monthly CPI prints above 0.4%, and the SPX loses 2 to 2.75%. All right, so 5% probability. I'm not sure what's actually expected on the core number. I'm not sure if you have that off the top of your head, Ryan, but looking at this, I would expect it's probably going to be like 0.35% or something like that. So if it prints above 0.4%, you can see this S&P low probability lose more than 2%. And then you're working probably towards that 6,200. A 25% chance that core monthly is between 0.35 and 0.4, and then the S&P might lose as much as 0.75 or gain as much as a quarter percent. So it looks like that 0.35 is probably like the inline number to pay attention to for tomorrow. If you're higher than 0.35 on core monthly, market's probably going down. If you're lower than that, then the market's probably going up. 35% chance that it comes in between 0.3 and 0.35, in which case the S&P could end up unchanged to up 0.75%. 30% chance that it comes in what appears to be light at 0.25 to 0.30, in which case easier inflation, might drive the S&P to gain 0.75% to 1.2%. And then finally, just a 5% chance that core month over month CPI drops to less than 0.25%. That would likely drive the S&P to rally between 1.5% and 2%. Thanks for that information. Great to know what JP Morgan is thinking. I would also note that JP Morgan was very significantly wrong on the movement based on the number on at least the last one print, if not the last two prints. So we definitely want to pay attention to that. I personally think that the risk is to the downside, that a hot number, it just really stymies the ability of the Fed to cut. And if the Fed can't cut when growth is slowing, then you got big problems from the market. So I think that the risk is to the downside on a hot number. We'll see if that happens. Also, what is the probability of a hot number? That I don't know, because I think that these analysts do a pretty good job of driving in expectations, right? Because the expectation is already that we're getting an uptick in inflation. Let me start by saying that. The expectation is already that we're getting an uptick in inflation tomorrow. So we're already expecting a little bit of a continuation of what we've seen on the last couple numbers now, which is that inflation is rising again. But it's not terrible, it's not dramatic, but it is rising. So we'll see, if that number comes in line tomorrow, we are seeing a continuation of inflation increasing. But if it comes in hot, then you got a really big problem. So it's still, goes back to the question on tariff impacts and timing of tariff impacts and how much of that is being seen in pass-through prices to consumers in July. So it's not even just like what the overall core CPI number is going to be. It's also going to be the components of it. They're going to be looking at goods inflation, right? Because goods inflation is primarily going to be coming from tariffs versus offsets that are coming from services inflation or probably lack thereof. And Billy D was providing a bunch of information throughout the day that housing should be coming down. So, the components within it are interesting. But I thought that I'm going to see if I can find it here in the VTF. Mike Reed posted a Goldman note in the virtual trading floor in the pre-market that I want to see if I can find, because it was kind of Goldman's expectations on the degree to which tariffs are being passed through at this point and their expectation for the future. Here, I just found it right now. Goldman Sachs says U.S. consumers will likely shoulder most of the cost from Trump's latest tariffs. Through June, households have absorbed about 22% of tariff costs, but Goldman estimates that could climb to 67% if the new levies follow past patterns. So that's really interesting. Let's dissect that a little bit further. So, timing on tariff pass-throughs, and one thing that we got to remember when it comes to goods inflation is that many of these companies did a really, really good job building up inventory, knowing that tariffs are going to be coming ahead of time. And I've spent a lot of this current earnings season that we're working through right now, paying close attention to what companies that are in the goods business have been saying about what they need to do with tariffs, right? And I would note that particularly with like middle income consumers, a lot of those companies did really bad on this last earnings season, like your Under Armours of the world kind of coming to mind. But I remember like a couple important ones, one being Procter and Gamble, because everybody buys products from Procter and Gamble. Soap, shampoo, toilet paper, all that stuff. They said that about 50% of their goods that they sell are going to be seeing price increases. I think they said starting in the end of July. So, circling back to this first part of this note from Goldman, through June, households have absorbed 22% of tariff costs. So who's absorbed the other 80%, 78% of tariff costs? It's been the companies themselves, it's been the exporters, or I guess to some degree, it's been the front loading by the companies themselves. But Goldman estimates that that number could climb to 67%. So Goldman is basically expecting that over time, the inflation cost from tariffs is which is a tax, is going to be passed through to consumers, and that when all is said and done, 67% of the increase is going to be passed on to consumers. Next, businesses. Businesses have so far carried around 64% of the costs. They may see their share drop to below 10%. So that's the next important one, is the businesses. So thus far, the businesses themselves have been able to absorb it, but they're only going to do that for so long, right? Because businesses, they want to protect their bottom line, and they either need to see their margins decrease or they need to pass through costs. And per the Goldman note, they're expecting that when all is said and done, businesses are only themselves through the margin compression going to absorb 10% or less of the actual costs. And then the final one here is foreign exporters, the exporter. Foreign exporter share could rise from 14% to 25%, right? So that's the idea that the people who are sending over the goods are also worried about demand decreasing because of higher prices. So they have to absorb some of that themselves through their own margin compression from foreign companies, right? And you got to be. This is why I think that this data is so important. Obviously, this is analyst estimates, but like, not to go on a diatribe about the media, but like, right wing media would lead you to believe that like the foreign exporters are 100% paying all of these costs, and these tariffs are just the greatest things in sliced bread, and it's just bringing in all this money to the country. And the left wing media would say that this is 100% a tariff, a tax that is being absorbed by households. Well, the Goldman note here, and these are the types of notes that I like to trust, because when you think about incentives, not to get too far off topic, but when you understand what someone's incentives are, then you understand what they're most likely to do. And I think that the big banks that are providing sell side information to like their clients, and their clients are money managers, they need to be providing the best, most accurate information possible, because otherwise those money managers are not going to do business with them anymore if they think that there's like some sort of left wing or right wing agenda. And at the end of the day, what does this Goldman note tell us is that this is a tax on households, but only 67% of the actual cost of the increase of tariffs is a tax to them. And 10% of that is margin compression, right? When I think Donald Trump said something about Walmart at one point in the past, like Walmart makes billions and billions of dollars, they can just absorb it. Well, they are going to absorb some of it. They're going to absorb a little bit less than 10%. And then those foreign exporters who, some might say are supposedly paying it all, are potentially going to pay 25%. So I just think that was like a super, super interesting note with really, really good information on it. The final part here is Goldman expects the shift to push inflation higher, projecting core PCE at 3.2% in December versus 2.4% without tariff effects. So in other words, you're getting like a 0.8% increase in inflation that is coming from tariffs. And then the final part of the question will be, is this sustained or not, right? That's Goldman doesn't get into this into the note, but that's the really important thing. Is this just a, one-time thing where you see it's gradual, it happens over time, and we understand why. But over the course of, this year, you're getting a 0.8% increase in inflation that you would not have gotten otherwise because of tariffs. But once that's in, then it's in, and we don't see any further increases, in which case the Fed should be able to cut without a problem and focus entirely on the growth side of their mandate, the employment side of their mandate, and not have to worry about pricing. Or does this somehow have an underpinning where it could lead to like a rolling escalation of price increases? I'm kind of inclined to think actually that it'd be more of a one-off impact, but I can't be sure. If it's a one-off impact, then, you know, big picture, it's not necessarily the end of the world. It obviously has a negative impact for the U.S. economy. We've got plenty of look backs and data that show that it does slow down growth and increase prices, or at a minimum, it slows down growth. But we can always just cut interest rates more and more and more to help be able to offset that. And we also have AI to help be able to offset that. So we will find out tomorrow what the CPI looks like for July. And we also have to keep in mind that it's honestly still early. Per that Goldman note that we just looked at, they're expecting that 0.8% increase to occur all the way through the end of the year. So you might see some of it tomorrow, you might see some of it in August. But when you also look at it in conjunction with the earnings reports, and when the companies who are involved in the importing of goods say they need to increase prices, a lot of them, they weren't saying July 1st. They were saying the end of July. So how much of that's actually going to be in the numbers tomorrow, we will see. But this CPI tomorrow, I think, is really, really important, because if it were to come in hot, it stymies the Fed cuts, and I think could be a really bad negative catalyst for the market. But if it comes in or light, in line or light, then that 90% Fed cut, that expectation for September, probably becomes a 100%, and this market continues to chop sideways is honestly what I think would happen, big picture. Or maybe it becomes the catalyst that actually leads to a real breakout. So we shall see tomorrow. It's going to be a really important one. As far as any other trading today, now that we kind of went through the bigger picture, I don't really have too much else to talk about. We had a couple good ideas today. We talked about the Tesla breakout through 338. I didn't like it because it was a day 4. I didn't take it. And it actually tailed down pretty nicely here in the close. It's almost retesting 338 right now. But some people, I think, took that as momentum breakouts. That was okay. We talked about Palantir, big picture here. So it was like a day 5 to the upside. I ideally would have wanted an RDR, but we said maybe that now that you got through the weekly OPEX, and the weekly OPEX for Palantir was important last week because it's the week in which it contains earnings. So a lot of people who've got, different hedges and things like that on for that earnings report. I was one of them. They're no longer influencing the market in the same way because that week rolled off. So, this Palantir is super interesting at this point, because if you scroll out and you look at this chart, this is becoming one of the most parabolic charts I've ever seen in my trading career for a real company. Like, you see the low float stock go crazy every once in a while, but this is not a low float stock. This is a good company too. I think it's a pretty solid company, but the valuation is nothing short of absurd, and the chart here at this point is nothing short of absurd. That parabolic move is something to behold. So we were saying in the morning meeting, like, I'm kind of looking for one of two things to really happen here. And I was really looking for this to happen on Friday, and it gave me a false signal in the beginning of the day. But sometimes when you get like a big, 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 crazy parabolic move like this, it needs to end with like a true blow off top, like a huge update, huge volume that then collapses in on itself and leaves you with an upside tail, or extends massively on day 1 and like king queens on day 2, something like that. And on Friday, in the beginning of the day on Friday, the first 2 5-minute bars with the up price action were on huge volume. I thought maybe that was going to be it. But then the third bar was a quiet bar, and I was like, that's not it. It's not what it looks like. And then we just digested the whole rest of the day. And then I was looking at this Palantir like over the weekend, and I was like, this chart is insanely parabolic with an insane valuation at this point. And I want to either look for one of two things, which is that upside capitulatory move. I think if you get that, I said this in the morning meeting today, and it's a big call. I think if you get that Palantir collapses on itself after, and whatever high it creates within the confines of that final thrust higher becomes like a multi-year high in the stock. I actually really think that. But that didn't happen. And the other option that I mentioned in the morning meeting today was, now that you got through weekly OPEX, maybe just the bottom falls out on this thing. Like, it held up so well on Thursday and Friday because you had to get to OPEX for the you had to get to OpEx for the earnings week, basically. And maybe now that you're through that, the bottom kind of just falls out on it a little bit. And that turned out to be more of what we saw, which is concerning. Like if you had the really major upside parabolic move, I know Joke would say I think that the stock is going to be done for like years when you combine the move with the valuation. But when you get the bottom that drops out, it becomes more like a maybe. Maybe this just is a technical pullback into the equilibrium zone that gives another higher low that continues the parabolic move a little bit further. That could happen. Or maybe it actually does become it. But all the same, we got through the OpEx of the earnings week, and then the bottom kind of fell out in a little bit today. It was very relatively weak. I know at the open I was calling for like a short through 180, 150. I said that in the morning meeting today. If the bottom just falls out, that happened. But then that trade kind of shook out. Unless you're giving it to highs, it actually held the opening high. But I know a lot of us were then looking at how it was retesting like 180, 150 and holding it as resistance and building this bear consolidation. And then that actually broke to the upside for two reasons. One was because the market bounced at that time, and two was this is a dirty stock. It really is. We talked about that in the VTF a little bit today, and it just kind of shook out that 180, 180, 150. And this is like all buy stops triggering for people that I think were short that pattern. So you got that little bit of a squeeze higher on that failure. And I called out a secondary trade off the actual high here, the 187.11 high on this candle, off of that exact premise that I just explained. I was like, guys, stock is still relatively weak. It's still red on the day. I think that this squeeze here was just a combination of market and day trader stops. And I was like, I also said I don't like it as much, but you could short this, I think, versus that high to see what it can do. And that trade actually worked really well. Pulled back, bounced a little bit, and then the thing, almost closed on lows. So we'll see. Obviously, this will be impacted by what the market does and what CPI does. Ryan here saying that the RSI on the monthly chart is at 95.79, which is insane. And the ADMA on the monthly is at 128.65. Yeah, for sure. So this one was a real focus for me today, just in terms of seeing how it traded and trying to be short the stock, and ended up being my best name on the day. But honestly, I feel like I should have done better. But it is what it is. So that was definitely a big focus for today. And then outside of that, Tesla Palantir, we were really focused to see on if NVIDIA and AMD could give those failures. They really did not. NVIDIA did not give the inside and down. Outside of that, it was a relatively quiet, range-based day in front of the CPI with a weak close. Market feels a little bit tired to me, but in order for that tiredness to really become selling, I think that you need to see a downside trigger occur, and we'll see if the CPI is that trigger tomorrow or not. So that's all that I've got, and I'm happy to answer any questions anybody has. Whew. Right. Scott Torbett on Lens, Lenz, Lens Therapeutics. Okay. Up 13% on the day. I don't know what the news was on it. Really big volume. I can just go ahead and tell you, uh, I I don't trade these names, so I'm not really going to be able to give you good feedback on it. I very rarely trade biotechs. I don't like them because it's always the biotech stuff. I don't have the capacity to do the research on all the drugs, is one. And two is it's always the biotech stock where you wake up and it's either up 300% or it's down 85%. And as much as I'd love to be swinging something long that gaps up 300%, I'm not willing to be swinging something long that gaps down 85%. So I just avoid these. You can day trade them a little bit, but swinging them overnight, especially if you swing them with any degree of leverage, I honestly think is a recipe to it almost just feels like gambling to me. You might make a lot, but if you're wrong, you could blow up your entire account by being leveraged in the wrong biotech when a bad drug trial comes through. So yeah, no real feedback for you on that one. I see you say that it's a low flow. Kind of can tell that a little bit by looking at the average volume. So You could day trade the squeezes in it, but personally, I would avoid anything bigger picture, and otherwise, I don't have great feedback for you. From Varun, will the Chinese names ever have a bull market again? I think that Alibaba looks pretty good. It did not have a good day today. But I like this overall pattern that Alibaba is still in. If we can get above, it has to get above 122. Um, FXI, I don't think has failed. It was interesting. I feel like the last time you asked me, FXI looked great. It was probably like a month ago, and it actually broke out. Now it's come back down. But the main names that I like to look at didn't look good. Like JD has been a real stick in the mud. So I don't know why that is, but I don't like JD's relative weakness compared to FXI. I would avoid the stock, even though I'm a traditional bull in the name. Baidu as well. Like I don't know why this Baidu can't perform. Like they're involved in the AI trade. Seems like they got one of the more important Chinese AIs. They're involved in the self-driving car stuff. Um, I guess you could argue that Google is also involved in those things and still trades at an obscenely low multiple. But yeah, Baidu's been another stick in the mud. Above 94, it looks good. 94 is far away. 82 to 84 is some support. Bob is the best looking one, I think, of the majors, and the FXI looks okay as well. But JD and Baidu, I would just avoid. So I don't have strong feedback for you on it. I'm a big picture bull on those Chinese names, but I do not like how JD traded today. Over in the YouTube from Cyril, thoughts on the Qs making a new all-time high and then closing on new lows. Yeah, I mean, kind of discussed it already. It's just this market to me feels very tired. It really does. But we can't seem to shoot the generals. Um, AMD and Nvidia, this the second time in 2 weeks I thought we would have a catalyst here that could really hit the leaders in the market and bring this market down, and we can't seem to do that. The AMD weakness on the earnings report, the new news today. So I don't know. The Nasdaq is what is holding things up. If you look at the RSP, if you look at the equal weighted S&P, this does not look good, right? This had this really big pullback. Um, as we had the whole market had that big 2-day sell off Thursday and Friday. The RSP actually started on that Wednesday, and yeah, it bounced back a little bit, but it's mainly been moving sideways since then, as opposed to the spies, which grinded all the way back up because the biggest component of the spies are basically the big QQQ names. And Apple helped grind that market up. And the semiconductors, they won't break down. So I don't think that this market is healthy right now, but I can't get the market to break. That's kind of where we're at. And maybe a little bit of a push through failure here from the Qs, which are the leaders, means something. Maybe it doesn't. It's so hard to say. Is the risk to the downside of the CPI in your opinion? Yeah, I think the risk is the downside of the CPI. I definitely do. If it comes in hot, I know that the JP Morgan note that we just read did not say this, but my personal thought process is the risk to the downside on a hot CPI is worse than the risk to the upside on a light CPI. Which is not to say that we won't go up on a light CPI. We will go up on a light CPI if it comes in below expectations. We will go up, but I don't think we'll go up as much as we could go down on an equally hot number. Do I think that Solana will follow Ether to break out? I have no idea. Is there a Solana ETF? If there's no Solana ETF, I got nothing for you on it. I could look at an Ethereum ETF. What is the? I know that there's ETHE, but I don't like to look at ETHE because it's a grayscale one. I don't like grayscale. I don't remember what the other ETHA. Thank you. Yeah, I mean ETHA's been on a run. Solana, I don't know. I really don't follow all the cryptos. Not my area of expertise. SOLT. There is a Solana ETF. I did not realize that. 2x Solana. It's a 2x Solana. Is there a single Solana ETF? This market's so nutty. They probably started with the 2x. Eslon. Slon. That's recent. I got no feedback for you on this one. I can tell you that broadly speaking, the 401k news that came out at the end of last week is very bullish for crypto. And I also say it's bearish for equities. Um, the idea, I don't know if it's passed through at this point or not, or if we got to go to Congress with it or whatever, but the idea that you can potentially diversify 401k investments now into real estate holdings or crypto or private equity is very interesting. It's obviously bullish for crypto because now you can buy crypto in your 401k, but I also think it's bearish for equities because talked about it really briefly in a meeting or just on the radio the other day. Like, there's been a lot of chatter, a little chatter here and there, I guess, over the course of probably the last 10 years at this point about why the market, the neutral PE ratio of the market, the last I really don't know starting from when, let's say 20 years, probably at least since the financial crisis or a little bit after, is consistently higher than the traditional standard PE that was from like the 1980s and 1990s. And one of the main reasons for that is that the components are so different. The components now, these major companies are very lightweight companies, as opposed to, in the 70s or 80s, they were primarily, manufacturing companies, whatever, things that are building stuff that have a lot more capital expenditures in terms of building the manufacturing and everything else. And now, if you're a software company, you can command a higher multiple. That's one. But the other major argument has just been the forced flow that just comes from like 401ks and retirement accounts. It just hits the market every single month, no matter what. That did not exist in the same way 50 years ago. So it's interesting that you might lose some of that 401k bid. It might go somewhere else, and that could be really great for crypto and really bad for, I think, not really bad, but not as good as it has been for sure for the equity market. So that'll be an interesting one to see over the course of the next 5 to 10 years how that plays out. From KitKat, the 2025 February top grinded multiple times before the free fall in April. Perhaps we are going to see the top grinding for a while before some big down move can happen. Yeah, I mean, we timed that February top perfectly though because it was a market dynamic situation. The high here is right in front of Feb OPEX, and we're starting to finally get the entire systematic community in the pool here. It's still not like 100%, 100%, but it was in February. We were there in February. Everything pointed to, you know what? We're actually very similar, I would say right now. The difference is the discretionary community is not as long as they were then. Here you had the discretionary community, the long shorts were in the 97th percentile of long exposure. Now you can see it even in Pat's note from this morning. The Goldman Sachs one, it's at 0. And I think there was another chart in here that showed the long shorts. Yeah, here. Look at the difference between discretionary versus systematic equity positioning. Systematic is this purple line. You can compare where that was, in February right before that drop off. But the discretionary community is light, actually. So they don't have as much to sell. It's the 30th percentile. Systematic's at the 84th percentile. So we're not quite where we were in February from a positioning perspective that really led to that sell down, but we are much closer. And we're also in a period of seasonal weakness now, which I think is important. From Sherry, the Palantir chart feels like the epic run is over. I think so too. I almost would have loved to have seen some sort of upside capitulation for that trade setup. But if the bottom falls out, we'll see. Palantir's hit a point here where the way it's moved is completely unsustainable. And at some point, this Palantir is going to have to go through a multi-year correction, I think, through price or time. I don't think it can continue to do what it's been doing. The multiple is going to take a decade to be able to catch up, even if they continue to exceed expectations. So we'll see. Definitely interesting. All right, gang. Looks like I got through everything, so I'm going to end the meeting there. Hope everybody had a great Monday. Get a good night's sleep. CPI tomorrow. I'll see you all there. And if you're